You know, usually when we talk about something like a medical diagnosis, there's this inherent expectation of precision. It feels almost like engineering.
Right.
You know, you fall, your arm hurts, you go to the hospital, and the x-ray shows that jagged white line. The doctor just points at the screen and says, well, there it is. That's the problem.
It's entirely binary. I mean, it's broken or it's not broken. It's a clean, undeniable fact sitting right there in front of you.
Yeah, exactly. And there's a strange comfort in that, even if it hurts. We fundamentally like things to be visible. We like our problems to be neatly categorized so we can just, apply the standard fix.
Absolutely.
But then you step out of that world, say, into the realm of neurodevelopment or complex trauma, and suddenly that x-ray machine is just useless. You're looking at a diagnostic landscape that is incredibly murky. You've got symptoms that overlap, root causes that are hidden, and just no single clean answer.
Yeah, you're operating in the absolute definition of diagnostic muddy waters. You have to rely on context, history, and behavioral patterns to even begin to piece together a picture of what's really going on.
Exactly. And I bring this up because that specific feeling, that sudden sinking realization of stepping out of a clean binary world and plunging straight into murky, complex waters is exactly what hits you when you are a small business owner. Specifically, when you open up a brand new, completely blank accounting software program for the very first time.
Oh, the blank screen of terror.
Right.
Yeah.
So welcome to this deep dive. If you're a curious learner, a business builder, or just someone trying to figure out how the actual financial engine of a company operates beneath the hood, well, you're in the right place. Today, our mission is to completely demystify the deeply intimidating world of small business accounting.
Which is quite a task.
It is, and we're using a very specific, incredibly rich stack of sources today. We're looking at the 2026 Localization and Accounting Standards Roadmap for the osFinancials and TurboCASH software ecosystems, and this is specifically tailored for the South African market.
Yeah, and it is quite a formidable stack of documents. I mean, if you just read the title, A Roadmap for Accounting Software Localization, it sounds incredibly dry.
Just a little bit.
Yeah, it sounds like the kind of paperwork only a senior compliance officer could genuinely love. But if you look past the technical jargon, what we're actually examining here is the structural DNA of a modern business.
Right.
Getting this underlying architecture right from day one is literally the difference between smooth, scalable growth and a massive business-ending headache when the tax authorities come knocking.
And that is the terror, isn't it? I mean, setting up accounting software can feel like trying to learn an alien language while simultaneously, trying to build a spaceship that the government is going to inspect next year.
That's a very accurate way to describe it.
But today, we're going to break down this intimidating roadmap into a practical, logical journey. By the end of our conversation, you will understand how to choose the right foundation for your books, how to adapt that foundation to whether you're a solo operator or a full-fledged company, and how to seamlessly align your daily operations with the strict demands of the taxman.
And we're also going to cover something really fascinating, how to run a financial operation that dynamically translates itself to speak your customer's native language.
Yes, that multilingual capability is huge.
It really forces a paradigm shift.
Yeah.
It takes the concept of accounting software, which is historically just a passive, backward-looking reporting tool, and turns it into an active, empathy-driven part of your customer relationship management.
So let's start at the absolute beginning, that terrifying blank screen. When a business owner first installs the software and opens it up, they aren't asked to just start typing in their sales. They're immediately confronted with a choice. The software demands that they select a template, or what the system refers to as a set of books. So if I'm a new user staring at that prompt, what am I actually choosing between?
Well, you're choosing your foundational language. The roadmap provides several highly specific generic templates built primarily for the South African market. So they offer default setups in both English and Afrikaans.
Oh, okay.
Yeah, and alongside that, there's a UK-specific template that demonstrates the software's broader geographical adaptability. But the language of the interface is entirely secondary to the real choice you're making here.
What's the real choice then?
By selecting one of these generic templates, you're opting into a structure that is strictly aligned with the International Financial Reporting Standards, which is commonly known as IFRS.
Okay, IFRS. I hear that acronym thrown around a lot in corporate news, but let's ground it for the listener. Why does a tiny two-person plumbing business in Johannesburg need to care about international financial reporting standards? I mean, it sounds like massive overkill.
It totally sounds like overkill.
Yeah.
Until you need a loan or until you want to take on a partner. I mean, think about what happens if you just open a blank spreadsheet and start making up your own categories.
Right, like just a list.
Exactly. You might create a column called Money from Pipes and another called Stuff I Bought for the Van, and that makes perfect sense to you. But when you take that spreadsheet to a bank manager to apply for a credit line to buy a second van, they have absolutely no idea how to read your business.
Because it's not standardized.
Right. They have to spend hours decoding your personal logic. So IFRS is the universal translator for finance. When you use an IFRS-aligned template, your books are instantly legible to any bank, investor, or auditor on the planet. You're adopting the global standard of financial truth.
Okay, so it's less about trying to pretend I'm a multinational corporation and more about speaking a dialect that the people with the money actually understand.
Exactly. It removes the friction of translation. And the beauty of the software's template approach is that you don't have to go read the thousands of pages of IFRS documentation to figure out how to structure it.
Which nobody wants to do.
Nobody. The template just does it for you. It uses a very specific hierarchical structure.
Mm-hmm.
So a 4-digit main category followed by a 3-digit subcategory that builds a skeleton capable of supporting a 1-person shop or a 50-person enterprise.
I'm trying to visualize this. It feels a bit like, walking into a high-end menswear store and buying an off-the-rack suit.
Okay, I like that.
The tailor who designed the pattern of that suit used classic, globally recognized proportions. That's the IFRS part. It looks professional, the shoulders are structurally sound, and it will be recognized as a quality garment anywhere in the world.
Right.
But because it's off the rack and designed to fit a wide variety of people, it's not going to fit my specific body perfectly the moment I put it on. I mean, I'm going to have to make alterations.
That captures the dynamic perfectly. The generic template gives you the professional silhouette, but you have to tailor the hem and the sleeves to match your actual day-to-day operations.
But following that logic, if this template is designed to scale all the way up to a large enterprise, my tiny plumbing business is putting on a suit that is, like, 3 sizes too big. Won't my software be absolutely bloated with hundreds of complex financial categories that I will literally never use?
Oh, it definitely will be. When you load the generic template, you're going to see accounts for things you might not encounter for a decade. But the software designers deliberately accepted that bloat because of a fundamental law of accounting architecture.
Which is?
It is infinitely easier to delete an unused account on day one than it is to try and surgically insert a complex IFRS-compliant category into a messy, active ledger 3 years down the line.
Because if I try to jam a new category in later, I might accidentally, break the way the whole system rolls up into the final balance sheet.
Exactly. You risk corrupting the entire reporting structure. So to prevent that, the developers build an ingenious spatial logic into the templates. They use an increment system for the subcategories, spacing them out mathematically, usually by hundreds, so that there are intentional gaps left in the numerical sequence.
Like leaving empty shelves in a massive library, just in case you ever buy books on a new subject. You don't have to rebuild the whole library. You just slide the new book onto the shelf that was reserved for that topic.
Exactly that. And they took it a step further to protect the user from the inevitable chaos of the real world. The roadmap heavily emphasizes the inclusion of standardized catch-all accounts, which usually end in a specific sequence of 9s. These are designated suspense or clearing accounts.
Suspense accounts.
Yeah.
Okay, what happens in a suspense account? Because that sounds like an Agatha Christie novel.
It really does. But it's actually where mysteries go to wait for a solution. So imagine you look at your business bank feed on a Tuesday morning, and there is a random deposit of 5,000 Rand. You have no invoice matching it. You have no idea who sent it. You might be a client paying an old bill, or it might be a weird bank error. In a rigid system, you might panic and classify it as sales just to make the bank feed balance.
Which instantly, artificially inflates your revenue, right?
Yeah.
And your tax liability.
Exactly.
Yeah.
Which is a total disaster. But with these pre-built catch-all accounts, you simply drop that mysterious 5,000 Rand into the suspense account. It sits there safely, it keeps your bank balance accurate, it doesn't inflate your sales, and it doesn't break your IFRS structure.
It just waits there in suspense.
Exactly. It waits until you do the detective work, figure out it was actually a refund from a supplier, and then you move it to the correct place.
It's a dedicated junk drawer for your kitchen. You need a designated place to throw the random rubber bands, the mysterious batteries, and that one key you don't recognize. Because if you don't have a junk drawer, that clutter ends up in the silverware drawer, and the whole kitchen feels chaotic. The suspense account protects the integrity of the rest of the ledger.
It isolates the unknown from the known.
That's exactly it. Okay, so we have our off-the-rack suit. We've got our professional IFRS silhouette. We've got some empty pockets for future growth, and we have a junk drawer pocket for emergencies.
Right.
But the very first major alteration the roadmap insists you make has nothing to do with what you sell. It has entirely to do with who you are in the eyes of the law.
This is a huge point. This is where the initial setup process diverges radically depending on your business identity. The software's generic templates default to a sole proprietorship structure, specifically in how they handle the equity section of the books.
Okay.
But the roadmap is incredibly strict that a user must immediately review and alter their foundational reporting groups to match their true legal structure. So whether they're staying a sole proprietor, operating as a partnership, or running a registered company, which in South Africa is typically a proprietary limited, or Plea Ltd.
Yeah, the sources spent a lot of time detailing how fundamentally different the sole proprietor setup is from the company setup. It mentions that if you are a sole proprietor, you actually have to go into the generic template and systematically delete all the corporate terminology.
You have to strip it out, because keeping it would be a legal fiction. We have to look at the philosophical foundation of what a sole proprietorship actually is. In the eyes of the law, there is absolutely zero separation between the individual human being and the business enterprise. The business does not exist as an independent entity.
So if the business gets sued, I get sued.
Your personal house is on the line. Because of that complete lack of separation, the accounting software has to reflect reality.
How does that look in the software?
Well, for example, the roadmap points out that the generic template might contain an account for an employee loan. If you're a sole proprietor, you must delete or ignore that account because you cannot legally be an employee of yourself. You cannot give yourself an employee loan.
That makes sense.
Furthermore, if you take money out of your personal savings and put it into the business bank account, that is not a corporate liability. The business doesn't owe you that money because you and the business are the same organism.
Yeah.
That money simply shifts from your personal pocket to your business pocket. So the software classifies it purely as owner's equity.
It really is like being a solo backpacker. I'm out in the wilderness, carrying everything in one large pack. If I take a protein bar out of the main compartment and put it into my jacket pocket, it's still my protein bar. I haven't loaned the bar to my jacket. I'm just distributing the weight differently on my own person.
That is the exact sole proprietor reality. And the software provides very specific mechanisms to track that movement. You have a dedicated account, specifically G300,000 for your initial capital contributions.
Yep.
You have a separate account, G3,300, specifically for out-of-pocket expenses. This is crucial for when you're at the office supply store and the business debit card gets declined, so you just use your personal credit card to buy printer paper. The software tracks that you personally infused value into the business at that moment.
Right.
And conversely, you have a dedicated account for owner's drawings, which is G3,200,000. That's for when you take cash out of the business register to pay for your personal groceries.
Tracking every time the backpacker moves a snack between pockets. I like that. But if my plumbing business grows and I decide to formally register it as a Plea Ltd, that solo backpacker reality vanishes entirely, right?
The change is absolute. If the sole proprietor is a solo backpacker, the Plea Ltd is a commercial airline.
Wow. That is a massive shift in complexity.
It is, because the moment you register a company, you have birthed a brand new, distinct legal person into the world. The commercial airline has rigid, legally mandated bulkheads separating the cargo, the crew, and the passengers. The company's money is no longer your money, even if you own 100% of the shares.
And the roadmap reflects this legal bulkhead by introducing entirely new sections to the ledger. The notes highlight things called non-operating revenue and non-operating expenses.
Yes.
And this is where things get really intense because the sources explicitly state that in these specific categories, operational accounting standards take a backseat and national tax laws take absolute precedence.
That's right. The software forces you to acknowledge that this new legal entity is subject to a whole new layer of taxation and regulation. I mean, the sole proprietor doesn't pay corporate tax or dividends tax.
Yeah.
A Plea Ltd does. And the software structure is engineered to stop you from treating the company like a personal piggy bank.
Which is tempting for a lot of founders, I imagine.
Very tempting. Let's look at taking money out of the business. As a whole proprietor, you just take a drawing. As a Plea Ltd, if you want to take profits out to buy groceries, you have to formally declare a dividend out of account G3,400,000. And the roadmap specifically brings up the solvency and liquidity test in relation to this.
Yeah, I saw that phrase, and it sounds like something a bank regulator would yell during a financial crisis. How does that actually work for a small company?
It's a legal safeguard built into South African corporate law, and the software's chart of accounts is designed to facilitate it. Before the directors of a PITI Ltd can legally move money out of the company's retained earnings account and pay it to the shareholders as a dividend, they must mathematically prove and formally declare that the company will still be able to pay all of its debts as they become due in the ordinary course of business for the next 12 months.
Wait, really? So I can't just drain the company bank account on a Friday to buy myself a boat, leaving the company unable to pay its suppliers on Monday?
If you do, and the company collapses, the corporate veil can be pierced, and you can be held personally liable for reckless trading. The software provides dedicated accounts to track these declared dividends separately from normal expenses because the tax authority taxes that movement of wealth very differently than a simple salary.
The roadmap also drops some heavy references to specific tax deductions, like Section 24I and Section 11A. For someone just trying to set up their software, these sound incredibly daunting. What is the software actually asking the user to prepare for here?
Well, it's preparing the business to navigate the realities of international trade and complex domestic tax law. Let's break them down. Section 24I deals with foreign exchange gains and losses.
Okay, so currency stuff.
Right. Imagine your plumbing company starts importing specialized copper pipes directly from Germany, and you agree to pay the supplier in euros in 30 days. When you make the agreement, the exchange rate is 20 Rand to the euro. You enter the liability into your software. But 30 days later, when the payment is actually due, the Rand has weakened, and it's now 22 Rand to the euro.
So it physically costs me more South African rands to settle the exact same debt. I've lost money without selling a single pipe.
Precisely. That is a foreign exchange loss. The generic template has dedicated non-operating accounts ready to catch that specific loss because Section 24I of the Income Tax Act dictates exactly how and when you're allowed to claim that loss to reduce your tax burden.
Wow.
If you mix that foreign exchange loss in with your regular plumbing supplies expense, your auditor would have a heart attack and your tax return would be rejected.
And what about Section 11A?
Section 11A is the general deduction formula. It's really the cornerstone of the Income Tax Act that dictates what general expenses a business is actually allowed to deduct from its income to figure out its taxable profit.
What's the rule?
The rule is that the expense must be incurred in the production of income and not be of a capital nature. The software structures your entire expense ledger to make it incredibly easy for your accountant to look at a category and instantly know, yes, this meets the 11A criteria, we can deduct it.
Let me throw a practical scenario at you, something that bridges the gap between the solo backpacker and the commercial airline. Let's say I'm transitioning my plumbing business into a company. I have this old, reliable pickup truck, a Backie that I bought personally years ago.
Okay, very common scenario.
Right. So I want to formally transfer this Backie into the new company, so the company owns it. Do I just look at it, guess it's worth about 50,000 Rand, and type that number into the software's asset column?
This is a classic trap, and the roadmap addresses it head-on with rigid compliance. You absolutely cannot guess, and you certainly cannot inflate the value. The software provides a very specific account for this scenario, G3000-200, which is designated for contributed capital assets at fair market value.
Fair market value?
Well,
Why the intense emphasis on market?
because human nature tempts us to cheat. You might look at that rusty 2005 Backie and think, well, if I tell the software it's worth 200,000 Rand, my company looks wealthier, my balance sheet looks stronger, and maybe the bank will give me a bigger loan.
Right, it's tempting.
But the software demands compliance with IFRS 13, which governs fair market value. You are legally required to record that vehicle at the exact price an independent willing buyer would pay an independent willing seller in an open market on the specific date of the transfer.
Because if I lie about it, I'm literally committing fraud.
You're falsifying your financial foundation. And what shows the true elegance of this software's architecture is how it handles the other side of that equation. We talked earlier about the catch-all suspense accounts ending in nines. The developers built what they call a mirror effect into the system.
A mirror effect.
Yeah. Just as there is a catch-all account for random assets you put into the business, there is mirrored catch-all account G3200900 for random value you take out.
So if I decide to take a set of brand new company-owned power tools home for my personal garage permanently.
The software has a mirrored drawings account, waiting to record that exact event. It ensures that every action has an equal and opposite reaction in the ledger. It keeps the financial ecosystem perfectly symmetrical, preventing value from just vanishing into thin air without a trace.
That's incredibly thorough. So whether you are the solo backpacker obsessively balancing the weight in your own pack or the directors of a commercial airline monitoring the cargo hold, there is a third party that is always watching. They are silent, they are powerful, and they always want their cut.
Yes, they do.
We are talking, of course, about the tax authority. In South Africa, that's the South African Revenue Service, or SARS. And the apex predator of small business compliance is VAT, value added tax.
VAT is the silent killer of small businesses.
Yeah.
It really is. So many enterprises go under not because their product is bad or because their sales are low, but simply because their accounting software wasn't capable of accurately isolating the government's money from the business's money. The business owner spends the VAT they collected, thinking it's profit, and then tax season arrives like a wrecking ball.
But reading through this 2026 roadmap, the localization for the South African market seems completely obsessed with neutralizing that threat. The level of granular detail applied to the VAT accounts is staggering. It doesn't just give you a generic tax category.
No, not at all.
The software's ledger accounts are physically mapped one-to-one to the exact fields on the official government VAT 201 return form.
It's a masterclass in pragmatic software engineering. The developers looked at the official government SORM and reverse engineered the entire chart of accounts to serve it.
Let's paint the picture of what this actually saves you from. If you don't have the system, how do you normally figure out your VAT? You have a giant shoebox full of receipts. At the end of the tax period, you dump the shoebox on your dining room table at midnight.
We've all been there.
You have to pick up every single piece of paper and make a decision. Did I charge 15% standard VAT on this? Was this a capital purchase? Was this an export that is zero rated? You are manually calculating tax fractions on a calculator, exhausted, terrified of making a mistake.
And mistakes in that scenario are inevitable, and those mistakes lead to audits, penalties, and just agonizing stress.
But look at how the software roadmap handles it. It provides an account specifically for the VAT you charge your customers on normal sales, and the documentation explicitly states that this specific account, T400111, maps directly to Field 1 on the VAT 201 form.
Right.
It provides another account, T400120, for the VAT you charge if you sell a piece of heavy machinery, and that maps directly to Field 1A.
It treats the money you're claiming back, the input VAT, with the exact same surgical precision. So the VAT you paid on your standard supplies, account T2400110, that maps to Field 15. The VAT you paid when you bought a new delivery truck, account T400140, maps to Field 14.
It is exactly like having pre-labeled, highly specific recycling bins in your kitchen. Instead of throwing all your paper, glass, plastic, and compost into one giant black trash bag and forcing yourself to dig through the rotting mess at the end of the month to separate it, you just sort it at the moment of creation. When you enter a transaction into the software, you drop it into the correct bin. Come tax day, you aren't doing any math. You aren't sorting anything. You simply look at the total in the software's Field 1 bin, and you write that exact number into Field 1 on the government portal.
The software has effectively performed the tax preparation silently in the background over the course of the month. All of those individual bins automatically calculate their net difference and roll up into one master control account, which is G24T2 private funded, labeled VA payable.
Oh, that's brilliant.
It is. At any second of the day, you can look at that single account and know exactly how much of the cash in your bank account actually belongs to SARS. It completely removes the illusion of false wealth.
Now, we do have to acknowledge a massive flashing neon disclaimer embedded in the source material. The developers state very clearly that tax rates change. Governments adjust percentages based on economic policy. The software provides the structural bins, but it does not guarantee the current legal percentage rate.
That's a critical distinction. The software automates the routing and the mathematics, but the business owner retains the ultimate fiduciary responsibility to ensure the system is calibrated to the correct current rate. You still have to verify with a professional that the standard rate is actually, 15%.
Okay, the recycling bin analogy works perfectly for the daily operational grind, buying supplies, selling services, collecting and paying cash. But I want to throw a wrench into this system.
Go for it.
What happens to the weird non-cash phantoms in accounting? How does this highly structured VAT-aligned system deal with something like depreciation? The fact that the shiny new backy I bought loses value every single day, even though no cash is changing hands.
This is where the roadmap reveals a profound and often misunderstood friction between standard accounting practices and government tax laws. The roadmap explicitly highlights the difference between IFRS depreciation and what the tax authority refers to as wear and tear.
I mean, I thought those were just two different ways of saying the exact same thing. A truck gets old, it loses value.
The physical reality is the same, yes, but the financial treatment is radically different. In your software's chart of accounts, you will have a series of expense accounts, usually in the G6400 range, dedicated to standard IFRS depreciation.
Right.
The purpose of these accounts is to present a realistic economic picture of your business to the world. If you buy a computer, you might estimate it'll be useless in 3 years, so your accountant writes off a third of its value every year in your books. This ensures your balance sheet accurately reflects that your assets are aging and will need replacing.
That makes logical sense. So SARS looks at that depreciation expense and lowers my tax bill accordingly.
No, SARS looked at that IFRS depreciation expense and completely ignores it.
Wait, what? They ignore a mathematically sound reflection of my assets' declining value?
Entirely. Because if SARS allowed every business owner to subjectively estimate how fast their assets degrade, everyone would claim their assets become worthless immediately. They'd use it to artificially create massive expenses and wipe out their taxable income. SARS cannot allow that level of subjective reality.
So what does the software do? Does it just leave me hanging?
Not at all. The software structure is deliberately designed to act as a filtration membrane. When your accountant prepares the tax computation, the software allows them to easily identify and reverse out all of that subjective IFRS depreciation. It basically adds that value back into your profit.
Okay.
And then it replaces it with an entirely different set of numbers dictated by Section 11E of the Income Tax Act.
Section 11E, the wear and tear allowance.
Yes. Section 11E is a rigid government-mandated schedule. SARS dictates exactly how many years you must spread the cost of a computer over, or a truck, or a manufacturing machine. You don't get to guess. You follow their schedule.
That's a huge difference.
It is. By providing separate structures for IFRS depreciation and Section 11E allowances, the software highlights the ultimate duality of business. It's the fundamental difference between your accounting profit, which is the economic reality of what your business achieved, and your taxable profit, which is the highly regulated number the government allows you to be taxed on.
That is a staggering realization. The software isn't just a digital filing cabinet, it's a specialized lens that lets you look at the exact same business through two completely different sets of rules simultaneously without mixing them up.
Exactly. If your software jumbled those two concepts together into a single depreciation account, you would inevitably base your tax return on the wrong number. You would either overpay the government unnecessarily, or you would underpay them and trigger devastating penalties.
I am letting out a massive sigh of relief on behalf of every small business owner who has ever dreaded a tax audit. The structural protection this software offers is immense.
It really is.
But as organized as the internal numbers are, the internal reality of a business means nothing if you cannot communicate with the outside world. Clear communication is the actual lifeblood of commerce. And if you're operating in a diverse, culturally rich nation like South Africa, clear communication requires infinitely more than perfectly mapped tax fields. It requires meeting your customer exactly where they are. Which brings us to the final and, frankly, the most breathtakingly powerful feature detailed in this 2026 roadmap.
The deep multilingual capabilities. This is the feature that elevates osFinancials from a standard monolithic accounting platform into a dynamic tool for localized commerce.
Let's set the sociolinguistic stage for a moment. South Africa is a nation defined by its diversity. It currently recognizes 12 official languages. The source material notes that South African Sign Language, or SASL, was officially added as the 12th in 2023.
Right.
Now, while a text-based user interface doesn't naturally translate to sign language in this specific operational context, the software goes to extraordinary lengths to support the spoken and written official languages. It utilizes what they call a multi-language accounts plugin.
And it's vital to understand that this plugin does not function like a cheap web browser extension that just pastes translated words over the screen. It is fundamentally integrated into the architecture. It allows multiple users to work in completely different native languages while operating inside the exact same set of books simultaneously.
Wait, let's slow down and explore the mechanics of that. You're saying two people are looking at the exact same financial database at the exact same time, but experiencing it in different languages.
Yes, the plugin operates deep within the relational database. It translates the core structural elements, so the chart of accounts names, the account groups, the type descriptions, and crucially, the specific stock and inventory descriptions. And it does this through per-user language settings.
So imagine a mid-size hardware store in Durban. The head accountant, who prefers to work in English, logs into the system. She pulls up the trial balance, and every category, every asset class, every liability is displayed in standard English terminology. But out in the warehouse, the inventory manager, whose native language is Afrikaans, logs into the exact same company file on his tablet.
And when he searches for a specific type of industrial fastener, the software displays the stock descriptions and the inventory categories entirely in Afrikaans. They're interacting with the exact same numerical data, the exact same quantities, and the exact same IFRS structure. The underlying mathematical truth is identical.
But the presentation changes.
Right. The software dynamically presents that truth in the language that reduces cognitive friction for each specific user.
That drastically reduces training time and internal data entry errors. But the roadmap details a feature that pushes this capability out the front door and directly into the hands of the customer. The documentation outlines something called dynamic database expressions. It mentions specialized placeholders and a specific data tag called the S-language expression. How does this actually interact with the consumer?
This is where the software becomes a tool for empathy. The S-language expression is a database tag that links a specific official language code directly to an individual client or supplier's profile in your system.
Okay, walk me through the practical reality of that. The hardware store is making a major sale to a local contractor.
Let's say the data entry clerk at the sales desk operates the software entirely in English. The contractor walks in and orders 10,000 rands worth of cement and timber. The contractor's primary language is isiZulu. When the clerk set up the contractor's profile months ago, they selected isiZulu in the S-language dropdown.
Okay, so the clerk generates the invoice on their screen. They see 100 bags of cement, standard rate VAT, total due. It's all in English.
But the moment the clerk clicks print, or the moment the software generates the PDF to email to the contractor, the multi-language plugin intercepts the document generation. It reads that S-language tag on the client profile. It searches the document for those dynamic placeholders like APP, and in a fraction of a second, it dynamically substitutes every English structural term and stock description with the verified, localized, E6 HOSA or isiZulu terms.
Wow.
The clerk never had to translate anything. They saw English. But the document that emerges from the printer is perfectly formatted in the customer's native language.
It functions exactly like the universal translator from a science fiction movie, but applied to commercial bookkeeping. You speak your operational language into the machine understands the universal math of the transaction, and it automatically speaks the customer's language on the output.
It's incredible.
Think about the psychological impact of that. You are handing a complex financial document to a client, and instead of forcing them to navigate a second language to understand what they owe you, you are communicating with them in the language they dream in. It removes the intimidation factor of business. It builds immediate, profound trust.
It is a massive competitive advantage. You're offering a level of bespoke, localized respect that usually requires a massive, highly paid, multilingual corporate communications department, and you're doing it automatically as a small business.
But let me play the dangerous devil's advocate for a second. If the software achieves this magic simply by substituting words in a database table using placeholders, and I realize that supporting all 11 spoken languages gives me an incredible advantage in the market, can I just take the English file, run the entire thing through a free online tool like Google Translate, upload the results back into the plugin, and instantly support every language in the country?
The source material is incredibly emphatic on this exact point. It issues a stark, uncompromising warning. No, you absolutely cannot do that.
Why the intense pushback? I mean, words are just words. If the translation app gets it mostly right, isn't that better than nothing?
Because accounting is not a casual conversation. It is a rigid legislative framework. If you use an automated translation tool to translate a conversational email and it uses slightly the wrong verb, the recipient might chuckle, but they'll understand your intent.
Right.
But if you use an automated tool to translate the concept of value-added tax or specific legal tax codes or SARS compliance terminology, and it chooses a word that implies a different legal concept in that native language, you haven't just made a spelling error. You have created a legally binding document that misrepresents a financial transaction.
You could accidentally alter the terms of a contract or completely misrepresent the tax liability to a supplier. The stakes are actually catastrophic.
They're severe enough that the roadmap explicitly insists users must consult local certified financial experts to verify that the officially accepted legislative terms are being used in every language file. The source provides a fascinating glimpse into the meticulous, painstaking work that goes into reviewing these files, specifically citing the development of the IFRS translation.
So the people building this aren't just looking up words in a dictionary, they are standardizing a financial lexicon.
Exactly. They are ensuring that highly specific structural accounting concepts are universally understood. For instance, they must guarantee that the complex accounting concept of a journal or a batch transaction is strictly and legally translated as e-generali, and that concepts regarding tax or VAT are universally standardized as IRFU.
Wow, that's precise.
This consistency is the bedrock of compliance. In fact, this issue is so critical that SARS itself had to publish a 450-word multilingual tax terminology glossary, purely to prevent taxpayers from falling into these exact translation traps and misunderstanding their legal obligations.
It is fascinating to note, though, that despite this incredible client-facing flexibility, the roadmap clarifies that English remains the default transactional language for the actual e-filing portal when you finally submit your data to the government.
It's an elegant, dual-layered solution. The software handles the complex, localized human interaction on the front end, building trust and clarity in multiple languages. But when it comes time to push the final data structure to the national government portal, it normalizes the output into the standardized format the government computers expect. It bridges the gap between human culture and digital bureaucracy.
And when you look at the raw demographic data included in the sources, you instantly realize why this monumental effort to translate the structural DNA of the software is not just a nice public relations stunt. It is an economic imperative.
Absolutely.
We're not talking about building niche features for a handful of specialized users. The census data highlighted in the roadmap shows that Isa is spoken by over 11 to 13 million people. Isa Lamega is spoken by 8 to 9 million people.
You're looking at roughly a third of the national population right there. Supporting these languages natively within your financial operations isn't just good customer service. It is actively tapping into the massive beating heart of the South African economy. If your business infrastructure cannot seamlessly communicate a basic financial transaction to 20 million potential customers in their mother tongue, you're introducing artificial friction into your sales process. And you're leaving an enormous amount of economic opportunity entirely on the table.
Let's take a deep breath and look back at the incredible terrain we've just navigated. We started this journey staring at a terrifying, blank, murky screen, paralyzed by the fear of making a structural mistake. But now we have a clear, navigable map. We know that you start by selecting a robust, globally recognized generic template, your off-the-rack suit, so that banks and investors can instantly understand your financial language.
You then meticulously tailor the equity section of that structural suit to match your exact legal reality. You determine if you're carrying the entire load yourself as a solo backpacker, moving value between your own pockets, or if you're operating a highly regulated commercial airline, bound by solvency tests and complex corporate tax deductions.
From there, you protect yourself from the ATAX predator by perfectly aligning your operational ledger with the tax authority. You set up those precise pre-labeled recycling bins for your output and input VAT, ensuring that the software silently prepares your tax return with every transaction, clearly separating your economic reality from your taxable reality.
And finally, you activate the ultimate localization superpower. You leverage the dynamic translation database to speak directly and with profound cultural respect to an incredibly diverse customer base, expanding your operational reach by millions of people without ever compromising the strict English-based compliance required by the government portal.
It completely clears the muddy waters we talked about at the beginning. If we step back and look at the bigger picture, it proves that while setting up accounting software will always require deep initial thought, it shouldn't be feared as a purely administrative chore.
If you followed a roadmap like this, you fundamentally transformed the software. It ceases to be a retrospective historical reporting tool that just tells you what happened last month. It becomes a proactive, defensive, and offensive business asset. It protects your compliance, it maintains your structural agility, and most importantly, it keeps your operations relentlessly focused on the customer's experience.
We started this deep dive longing for the clean and binary certainty of a medical X-ray. Broken or not broken. We want the inner workings of our problems to be visible. And while the fluid world of commerce and taxation might never be perfectly simple, implementing this level of deliberate, localized architecture gives you that precise visibility into the heart of your business. Which leaves you, the listener, with a final thought to ponder as you look at your own professional systems today. We just spent a significant amount of time exploring how a piece of software uses dynamic database fields to automatically alter the language of a sterile administrative invoice, basing that complex calculation entirely on a desire to make the customer feel seen, respected, and understood. If a tool as notoriously rigid and unfeeling as small business accounting software is now sophisticated enough to adapt its cultural language to build genuine human connection, what other rigid, automated, or deeply administrative areas of your own business could you reimagine today to create a more personalized, profoundly human connection with your market?